So YouTube is preparing the video and we are live now.
Perfect. Yeah, hello everyone. Welcome to the Payment and Banking 5 p.m. Club. I'm super excited to moderate this discussion on the crypto landscape today. And I think the fact that we're even having this discussion here with Payment and Banking shows how crypto is finally pushing its way into the mainstream of finance. Plus, we have some really cool people here today from diverse backgrounds. So yeah, very excited. Let's maybe start this with a quick introduction. Maybe I'll start. So yeah, I'm Emmanuel. I work at Satoshi Pay, which is a crypto payment provider. And on the side, I also run a website called cryptotesters.com, where I try to educate people about crypto. Ben, maybe?
Oh, I'm Ben. I'm the reason we're speaking English today, so sorry to for everyone who would prefer to speak German. I'm the CEO, CTO, and one of the 3 co-founders of Bitwala. So we are the world's first cryptocurrency bank account. So everything you'd expect from a neobank like an N26 or a Monzo, but with integrated cryptocurrency, trading, and wallet.
Alex?
Okay, hi, my name is Alex. Thanks for having me today. I'm 50% a PhD candidate at the University of St. Gallen, finalizing my PhD on monetary theory currently. And the other 50% I'm at Deutsche Bank and I'm working there in strategy and I'm responsible for everything related to digital currencies.
Yeah, let's maybe proceed vertically. Patrick?
Yeah, hi everyone. Thanks for having me. I'm Patrick. I'm head of blockchain at Bitkom. Bitkom is the largest digital association in Europe with over 2,000 member companies. For example, all those companies represented here in this panel. And we're working, closely with the crypto and blockchain industry and the political and regulatory landscape to create, the ideal conditions for blockchain and crypto businesses to strive in Germany.
And I think finally it's me, Peter Großkopf. I'm currently Managing Director and CTO at Börse Stuttgart Digital Exchange. We're operating an exchange for digital assets and aiming to become the biggest one in Europe within the next years. Also, hopefully, the trading security token and different digital assets that we all don't know yet in the future. Before that, I was the CTO and co-founder at Solaris Bank and worked at company builders and in background.
Cool. Yeah, so we have a lot of different topics on our agenda today, from Bitcoin, decentralized finance, stable coins, and also central bank digital currencies. And the reason we have so many topics is to really give a broad overview of the ecosystem. But actually, I also think that they fit quite nicely together because I think they all have something in common, and that is that we're really currently seeing a transformation of money. So we've seen money evolve several times in history, from commodity-based money in form of pearls or gold. And today we have like politics-based money. And I believe we're currently seeing a new form of money, and it's money that's based on math and technology, and money that is to some extent decoupled from the state. So I guess a good place to start this discussion is to ask, how does money work today? How is it issued, and how does it maintain its value? So this is the system that is known as fiat money. And I think, Alex, you have a lot of opinions on this topic, and maybe let's start with you.
Okay, sure. So I try not to talk about opinions now. I will just try to describe how the system works. So I think the best way to start is to talk about that we actually have two forms of money today, which we call fiat money. First, it's a central bank money. So that's the money that's issued by the central bank. And the second form of money we have today is commercial bank money. So that's money that is issued by commercial bank. And I think one important thing to understand is that both of these forms of money are created by extending credit. So the central bank lends money to the banks, and this is how central bank money is created, and banks lend money to us, and this is how commercial bank money is created. So every money that exists out there is basically the debt, right? So we have a debt-based money system today. And maybe one last important fact is that central bank money, that's the only form of legal tender, right? That's what I would call the true money. And we, normal people, can only hold this form of money in physical form, meaning cash today. And only banks are allowed to have digital bank accounts of real money, or allowed to hold real money in form of bank accounts. And commercial bank money is actually not legal tender. It's simply a liability of the bank. So we maybe have to make this differentiation.
Right. Yeah. So basically what that means is that you don't actually own the money that's in your bank account. You have a legal claim to it, but it's really just an IOU. And yeah, I think Bitcoin really is a fundamental shift away from this model. So let's start now, like diving into Bitcoin, and we'll come back more towards like this topic again when we cover central bank digital currencies. But and this was really just to give a quick intro. So let's talk about Bitcoin. Ben, maybe I know that you started really early your Bitcoin journey. I think like 2013 or something. So maybe let's start with you. Like, can you describe Bitcoin? What makes it unique? What excites you about Bitcoin?
Yeah, absolutely. Bitcoin is like a warm feeling that you get inside of your belly on a summer's day. No, so I think like first and foremost, I want to say that we have Bitcoin and we have blockchain. Blockchain is a technology, and cryptocurrency is the application, and Bitcoin was the first one. So a lot of people are confusing these two topics. So the way I describe Bitcoin is, well, it was a progression of the kind of digital money that we already had. So if you go on your online banking, then you see a digital representation of your money. So money is already kind of digitized to a certain extent. If you go on PayPal, then you have this ledger where you can send money between two different people. But what Bitcoin allowed you to do was to have a functioning monetary system, or a system that allowed the transfer of value in a trustless way. So with PayPal, everything that you transact is going through the central PayPal servers, right? So you log in, you authenticate yourself, and I'm sending you $10, Emmanuel, and then it's updated on the ledger. With Bitcoin, you can do it without trusting any kind of central entity, like a company like PayPal, or like a central bank like the ECB, for example. And so what Bitcoin did was basically pull together a number of emergent technologies. So this idea of having a cryptographic ledger. So you pile transactions into blocks, and then you link these blocks together cryptographically so that you can, it's very, very difficult to change things that have already happened. And then there's this idea of distributed computing, where you have multiple nodes all trying to find consensus about number of transactions. So ultimately, what Bitcoin allows you to do is to send value to someone anywhere in the world using just an internet connection. That doesn't need to be a bank account. There doesn't need to be any KYC. You have your private keys. You create a transaction. You sign the transaction yourself, and then you broadcast it to the network. And then the network is incentivized in terms of mining fees and block rewards to verify your transaction. And what is happening in the background is you have all these nodes. They all have a ledger of all of the transactions, and they are constantly figuring out what is truth, what is not truth, and coming up with a consensus. And so you have this unified global ledger, and that is the mechanism that allows us to transact value without using the ECB, without using PayPal.
Yeah, I think this is really the sort of peer-to-peer network that underlies Bitcoin and also other blockchains, right? This is the kind of foundation. But then we have Bitcoin, the asset also, right? And yeah, Bitcoin, the asset, is also very different in many regards from like money that's issued by governments. So yeah, maybe Peter, do you want to explain a bit about how Bitcoin, the asset, works from like a monetary perspective?
I actually would have added one more thing to the explanations of Ben, because you all know during the last weeks and months, we've read and heard a lot of news about Wirecard and the banking system and the auditability of the banking system and this kind of stuff. Because if we compare the blockchain world to the traditional world, the traditional world tries to generate trust through audits and kind of showing to external people, to customers, that there are some rules and that the companies and banks are following the rules, and that there's some sort of proof which is made by auditors and made like once a year typically. And I think the interesting aspect about especially permissionless blockchains like the Bitcoin blockchain is that it's completely open. So everybody who wants to have a look into the transaction ledger can figure out what transactions have been made. Of course, they're pseudonymous, so which means there's like you only see IDs, which means you don't know the real person behind it. You can't figure that out that easily who made the transaction, but it's pseudonymous and it's open and you can't audit them. You can audit as well the source code of the Bitcoin blockchain and of the implementations, and kind of give a guarantee that the whole system is working as it's supposed to. And I think this is the real powerful aspect of it, because maybe also think so. Also coming from the Wirecard issue from the last few weeks, I also put some thoughts into like the situation, and I'm thinking that if we would have permissionless blockchains in the future as the main ledger for financial transactions, that would also open it to let's say non-profit audit companies that could be created. So like Amnesty International for financial safety or something like that. Maybe I should register the name. And you could open this up and there would be real and really also non-coupled external audits on the whole system. And I think this could be also really huge improvement to the way the financial system works today.
Yeah, sorry, you go.
So to touch more on the monetary aspects of Bitcoin as we're going into the direction of central bank stable currencies, Bitcoin was philosophically created in the time just after the financial crisis, so the 2009 financial crisis, and it kind of said, well, humans are bad at monetary policy. The private banks are making mistakes. The central banks are making mistakes. So rather than have people decide about the money supply and about how the money can be used, let's just turn it into numbers. And the kind of unofficial catchphrase of Bitcoin is "Vires and numerous," which is a trust in numbers. And so Bitcoin is very different from other money in that there's a finite supply. There will only ever be 21 million Bitcoins. And it's actually a predictable rate at which new Bitcoins are being created. So theoretically, the ECB tomorrow could just double the money supply, and then everyone's savings will be effectively halved. I mean, that is a little bit what is happening right now with the reaction to the corona crisis. But with Bitcoin, that will be impossible because the supply is predetermined. And the fact that it's limited is why people liken Bitcoin to digital gold. In times of crisis, when people don't trust the government's monetary policy, like in Argentina, like in Venezuela, then they will flock to a more stable asset. So for example, dollar opposed to the Venezuelan peso. And then in countries where the dollar is readily available, then people flock towards gold because gold will always be scarce. And so Bitcoin is kind of a digital gold. I would say it's a counter bet to the traditional monetary system based on fiat money.
Yeah, so it's really those two pieces, basically the peer-to-peer network that allows people to self-custody their funds, not have it stored with a third party where it's only a claim on the asset, but really have it almost physically in their wallet, and also, of course, the ability to send that money to someone else in that network and have the transaction validated in a decentralized way. And then you have the kind of monetary aspect of Bitcoin, which with the scarcity, the 21 million Bitcoin that are going to be, which is the maximum that's going to exist. Okay, so yeah, maybe Patrick, where do you think we are in terms of kind of Bitcoin adoption? Do you think, yeah, what's the state of Bitcoin today?
Yeah, I mean, to come back at the initial question, what is money? I think many of you guys also know the main money theories. You know, what is money? What functions does money inherit? And I think the main three functions always mentioned are basically unit of account, payment system and payment tool, and the third one is store of value. And I think we already touched on most of them, but I think if we look at those like 10 years of Bitcoin existence, initially Bitcoin was really constructed as payment infrastructure, and in the end as peer-to-peer payment system for everyone. And I think due to different reasons, I guess many of them linked to the usability of Bitcoin, but also linked to the huge fees which are linked to the usage of the Bitcoin network. It evolved more and more towards this store of value function, money function. And I think this is how Bitcoin is perceived by most people nowadays, as store of value, as alternative investment, as alternative asset. And I think, if we look at adoption right now, I would say that most also institutional investors, which are now looking at Bitcoin as an asset, look at Bitcoin as, capital asset and not as transactional and payment system. So I would say it definitely moved and evolved towards the storage value. And in the end, that's how, decentralized peer-to-peer networks work. In the end, the community decides what kind of money and what kind of function this whole network gets and becomes. And I think, there are definitely signs for more and more institutional investors hopping on the Bitcoin train and investing into Bitcoin, or even regulated financial market players such as Börse Stuttgart and others, providing the on and off ramps for retail investors to buy Bitcoin and hold Bitcoin. So I think we definitely are at the beginning of I would say, a Bitcoin adoption phase, institutional adoption phase.
Yeah, I'd just like to comment on what you said, Patrick. I think you're entirely right in that Bitcoin is now seen more as being an asset rather than a transactional currency. I think I read the other day that 60% of Bitcoin is estimated to be held. So in the hopes that it will appreciate. Back in 2013, we were in room 77, like at the Bitcoin Stammtisch, and there was already this mentality that Bitcoin would displace Visa and MasterCard and become the de facto global currency. Right, because back then you could send Bitcoin without fees, so you could even make small payments. And that's actually how we started off doing business. We made Bitcoin spendable. We created e-commerce shops where allowing people to spend their Bitcoin. But then over time, it turned out people wanted to hold their Bitcoin because the price was going up and the fees were going higher and higher, so that you couldn't just buy a single beer with Bitcoin. So you had to have at least 2 or 3 beers at room 27. What a shame.
Also there's probably the fees is the one aspect why it's more used as a store of value. It's also the aspect that it couldn't carry the weight of the number of transactions to really replace Visa and Master and the big card schemes. Because in the end, yeah, so even after the latest updates, Bitcoin blockchain is not able to carry as many transactions, not by far not able to carry as many transactions, and therefore it's probably. So I compared it some years ago as the Dampfmaschine of the blockchain, so like the steam machine. I don't know if it's the right translation into English. That kind of kicked off the industrial revolution, and probably the Bitcoin blockchain did the same for the blockchain space, because it showed the potential, and it was the, like you said, Ben, the first real use case that really proved that this technology is working and that you can really use it for real world transactions. But in the end, after that, there came kind of all the newer blockchains. Ethereum made things different, and EOS and all the other guys also again learned from the Bitcoin blockchain. And I think this led us now to kind of like the second generation, where you probably see a different potential, also waiving the amount of transactions.
Okay, but now I think we really have to be cautious, right? Because I wouldn't call Ethereum or EOS like this as an evolution of Bitcoin, right? These are totally different technical, totally different use cases, because if Ether is not money, right? For instance, so Bitcoin is really this use case. I mean, we call it digital gold, and I totally agree. It isn't really money, because it won't ever be used. At least the base layer Bitcoin will never be used as a medium of exchange, because it's unscalable. I think we agree on that. But still, Bitcoin is the best version out there that actually captures this digital gold use case, and I would not compare it to Ethereum or any of the other projects, because that's something totally different. Ethereum is smart contracts, like right distributed computer. Bitcoin is digital gold.
Yeah, I think the analogy of the steam engine would kind of imply that the next generations of blockchains are going to kind of replace Bitcoin. I think Bitcoin will definitely continue to exist. Some people even say that this kind of low throughput, so the low number of transactions that Bitcoin, the base layer, is able to process is a feature and not a bug, because the fact that only a limited amount of transactions go into every block that is mined every 10 minutes means that in order to get your transaction mined, you have to attach a sufficiently high fee to it, and that creates a fee market. It's a sufficiently high competition basically among users who want the transaction mined. And this fee revenue is of course important for miners, and the more miners come into the network and provide hashing power, the more secure this base layer becomes. So I think it's a huge debate in the Bitcoin, also in the Bitcoin community, where that has led to forks and all of that, but maybe that's too much for this discussion. But I love the point that we reached with like Bitcoin as digital gold. And Patrick, I also agree that we are reaching a point where we're seeing like institutional investors coming into the space. I read the other day that MicroStrategy, a Fortune 500 company, put like 1.2 billion, if I'm not wrong, of their and added like Bitcoin to their balance sheet, just to kind of prepare for what's ahead with, like fiat currencies maybe inflating in the future. So I think, that's something that I expect to see a lot more going forward. What do you guys think? Whoever has an opinion on that.
So I think we already agreed on that, right? Bitcoin will be treated as an asset that has to be a part of every diversified portfolio. will not be used as a means of payment in the near future. I mean, what we haven't mentioned today, what we probably should mention, are second layer solutions that might make Bitcoin usable as, or that might create some scalability for Bitcoin, right? Like the Lightning Network, for instance, that maybe makes Bitcoin easier spendable and cheaper, such that Bitcoin actually might move a bit more towards this usage as true money in the sense of medium of exchange. But in general, I see it really as an asset that's part of an investment portfolio.
And even if we solved the transaction throughput issue with the Layer 2 solution, we'd probably still have this high level of volatility, right? So people aren't accustomed to prices changing day to day. And I think that is an additional barrier. If we talk about stable coins, well, then we can have the technology without having the volatility, perhaps.
Yeah, and I think that is quite similar to gold. I mean, of course, gold is not as volatile because it's established now as a store of value, but it's a lot more volatile, of course, than the US dollar. Yeah.
And also maybe just to add another reason why probably Bitcoin is, I mean, in my opinion, probably not gonna be, even if we see those layer 2 solutions like succeed, I don't really think Bitcoin will evolve into a real electronic payment system, how it was supposed to function at the beginning, because I mean, there isn't really much to do with Bitcoin at this point, even if we compare it to other blockchains, like, for example, smart contract blockchains like Ethereum, where you can use Ether, or I mean, gas in the end, in order to, you know, make financial services happen, in order to make all kinds of transactions, like in order to automate all kinds of transactions. Bitcoin in the end is kind of limited in its functionality. So I think even if we had those layer 2 issues solved, I don't really would see Bitcoin as a payment system in the future.
But these missing functionalities, that's actually a strength of Bitcoin and not a weakness, right? Because that's the only thing why we would use Bitcoin, because it's this digital gold and we don't need anything related to smart contracts or whatnot. First, we need stability, and we need that everyone follows the rules. And this is what everyone believes, that this will for sure happen in Bitcoin. And that's actually more a feature than a bug, I think, that it's so focused and so narrow.
Yeah, for sure. Yeah, for sure. And if we look at market caps, just a quick add, like I think Bitcoin is nowadays 2% of the market cap or the volume of gold in the market. So I think there's still, I mean, huge potential for Bitcoin as a digital store of value. And also, if you compare, like in the polls, especially young people really see Bitcoin nowadays as alternative capital asset. And so I am extremely hopeful and bullish that Bitcoin will even like grow further in its role as alternative investment asset. But I think, at least in the medium term, what will be interesting in the long term, I think, I mean, talking about the year 2140 or so, when there are no more mining rewards, that will be interesting to see, like how Bitcoin, you know, comes up with this challenge then when only the transaction fees are coming up and covering up for the mining calculations. And I'm happy to like have your opinion on if this is going to succeed in the long term.
So the only way it can succeed is if we only channel really huge payments through the base layer, right? So maybe I'm not sure how familiar or the listeners here are to how Bitcoin works. Currently, you have the block reward that rewards the miners, and on top of that, you have transaction fees, and the block rewards will disappear. So there is less incentive for the miners to secure the network. So transaction fees have to rise, and the only way this can happen, if instead of having small transactions going through the blockchain, we need really huge transactions, such that even if it's only a small part of the transaction, it's in nominal terms a big amount of money, right? So I believe that the only way it can work is if the base layer of Bitcoin serves as a settlement layer, so only wholesale payments, really huge payments, are channeled and settled through this Bitcoin base layer.
Yeah, I've also read opinions of people saying that at this point, and it's all speculation, because as you said, it's in 2140. Until then, there's still the block reward, so new bitcoins being issued and miners having a sufficiently high incentive. But yeah, what's happening past 2140 is speculation. I've read opinions of people saying that by then, like exchanges and other companies that are building on this infrastructure and depending on Bitcoin will maybe mine altruistically, or even governments who are holding reserves in Bitcoin the way they hold gold today will mine and stuff. But yeah, I guess that's all speculation.
This is actually the reason why I made also this this comparison with the steam machine, because in the end, even the steam machine, even if it's not used in factories anymore, it still has a kind of a value, because it kicked off this this whole era, and kind of also can be found at least in museums, and people like it and are probably paying huge amounts of money for the machines, because it's such an important step of development of the whole humanity, and therefore I can also believe that even if the network in the future, like in the very far future, 2140, is not used that often anymore, also for the cases that you, Alex, for example, mentioned, I think it still will have some sort of intrinsic value, because people will look back and say like, okay, so this technology kicked off this whole new era, and therefore it has a value.
Yeah, maybe this is a good time to switch topic. I didn't expect that we'd talk half an hour about just Bitcoin.
Come on, it's great.
Yeah, no, it was a good discussion. Yeah, let's talk about so what comes after the steam engine, the electric motor, or what is it?
The Ford Model T.
That's all right.
Okay, let's talk about the Ford Model T, which is Ethereum. No, but yeah, let's talk about Ethereum. I think, and again, to proceed like chronologically, I think the first killer application on Ethereum were stable coins, right? So basically fiat money in form of a token on the blockchain, and we've seen an explosion of stablecoins, both in number of different stablecoin implementations, but also in volume. So I think we're now at like $15 billion worth of stablecoins on just Ethereum. And yeah, maybe yeah, Peter, do you want to describe what stablecoins are, and then we can talk about why do you think there's this huge increase in stablecoin?
Yeah. Well, stablecoin is like a digital currency that tries to adopt the quality of real money, so that it has a stable value to a token, and which means that you could use a stable coin in payments, and you could pay your beer or your gin or whatever you're drinking over there, and you won't you won't cry afterwards that price went up 25% after you finished your gin. And yes, and that's kind of the idea behind it. So far, you see different projects tackling that let's say problem, or that thing. So there's the projects who try to use real money, so like fiat money, and use it as like packed fiat coins. So there has been USDT, so like the Tether dollar, around for quite a while, which worked in a way that there was somewhere, hopefully, a bank account behind it, where people paid in money, and then for each dollar which has been paid into that account, there was one Tether dollar issued on the blockchain, and you could use it as an equivalent for a dollar, which means you could buy on different crypto exchanges, Bitcoin, Ether, and different cryptocurrencies, and you also had the opportunity to switch back or to sell your positions when the prices went down and you had it kind of stable in your account in Tether dollar, you were able to wire Tether dollar to other exchanges who accepted Tether dollar, and that was kind of probably not the way the blockchain maximalists were thinking about stablecoins, because in the end it still makes use of the monetary system like it is today. So there are also early projects for Euro stablecoins and for other pegged stablecoins for fiat currencies. But yeah, so that was actually not as intended as the blockchain maximalists wanted it to have. And kind of the second way of doing it, and that's probably the one which makes it really interesting at the moment to also look into the DeFi world. It's the projects that cryptographically generate or issue a stable coin, and in the end, this stable coin is not bound to a currency or something like that. It's coming kind of from it's issued on the blockchain, and you can use it in various ways. So like especially in the DeFi world, there are now a bunch of projects like lending projects where you can lend against your stable coins and get an interest rate and so on and so forth. And probably this space gathered a lot of attention during the last 12 to 16 months. So for example, in the Maker universe, there's so much money which went into that space, because in the end, well, I compare it always like to the traditional banking world. If my mother wants to get a stable interest rate from her bank funds, then she needs to invest into, I don't know, if you get probably like less than 1% on a bank account in Germany, you get probably 2 or 3% in Portugal, and if you even go more exotic, you get a few more percent. But then it's already quite an unsafe investment, because the banks could explode. And so if now in the DeFi space, there's now a lot of opportunity, which is to get interest rates, and I think therefore people are seeing it now as a very interesting way also of parking the money and investing like with a relatively low risk.
Yeah, I think that's a really good point that you raised, which is also the high yield that people are able to get when they have money in form of stable coins on a blockchain. They can invest it very profitably, more so than in the normal financial system. And I will talk again about that when we talk about decentralized finance. But you've mentioned different flavors of stablecoins basically. So one, the kind of fiat-backed stablecoin like Tether, where there's like a bank that puts real dollars, so to say, in a bank account and issues the equivalent amount of tokens on the blockchain. And then you have the synthetic dollars or cryptographic dollars like Maker DAO. DAI is the name of the stablecoin, and they are more like backed by also backed by something, but in a decentralized way. They're backed by Ether. But let's factor out decentralized finance for a bit and talk more about why people hold these stablecoins. Yeah, like what are the use cases that are enabled by these stablecoins? Maybe Patrick, you want to jump in?
Yeah, sure. I mean, I would say in a few words, stablecoins try to combine the best of both worlds. They try to have the stability of fiat money and combine them with the programmability of, for example, cryptocurrencies and digital currencies. And I mean that's why stablecoins are so on vogue, and they're basically I mean, their main use cases are, as already mentioned, in the payment system and as a transactional means. So they could be used, and they are already used for example, remittances, for international money transfers. They could be used for micro payments in the industrial space. They could be used for transactioning in the financial sector, for like buying other capital assets. Yeah, I think, I mean, the main reason why stablecoins are really trending is because people just figured out that, I mean, as already mentioned, those native crypto assets such as Bitcoin would be just way too volatile to be used in as payment means.
Alex, do you have something to add to that?
Yeah, maybe a note of caution. So I'm also a fan of stablecoins, but we still have to make ourselves clear. Tether, for instance, or maybe also something like Libra will also be a stablecoin, right? And there will be something like a Libra euro. These are not true euros or true US dollars. And you see this already because there is an exchange rate between the true euro and the true US dollars and these stable coins. So we have to, it has to be clear that these are issued by private institutions, and you need to have some trust in these private institutions. If we talk about a Tether or later Libra then, so you have to trust that the Libra Association is actually managing the Libra reserve well, such that there will be no default, no liquidity events and these kinds of things. So it is a bit dangerous to talk about Euro stablecoins and treat them like Euro. But in the end, it's not really the euro. And this becomes especially important if we think about industry applications. Like Patrick has mentioned, micropayments, right? Let's say some company offers these micropayments, and I'm not so sure whether big companies, and we're talking about billions of payments, whether they feel so comfortable using stablecoins, because there is some credit risk involved still.
Yeah, but don't you think that, for example, there's also some risk in the euro deposits that you have in your bank account? If you think about fractional reserve banking, like the Tether or USDC, they're supposedly backed 1-to-1, right? Whereas like your euro deposit in the bank, it's backed like 1-to-10 or something like that. So I would argue that there's more risk actually in euro deposits.
Well, there's one important difference between Tether and the US dollar in your bank account. Behind the US dollar in your bank account is a lender of last resort, and that's the Fed, right? And the Fed will never let it happen that the US payment system breaks down. While if we all say, let's move to Tether, and at some point Tether breaks down, there will be no Fed standing behind Tether and ensuring that actually these payments get through during a crisis. So whenever we have a really bad crisis, and just look at the last months, the Fed actually jumps in. I mean, we all have seen what the Fed has done during the last months, right? It has massively increased its balance sheet, massively pumped US dollars into the market, and this would not happen if we all rely on Tether, and the same happened because there's no Fed behind Tether.
Yeah, but also to put it really clear, the example you gave is right. So like it's not the money like on a real bank account, but I think in many ways this money is treated like e-money. So it falls into some sort of regime, but it's definitely a different regulatory regime as when you have money or if you have fiat money on a real bank account.
And just
I think it then it also differs like how.
Yeah, just to add one more point to Emmanuel's comment. I mean, Emmanuel, you just said, I feel more comfortable using Tether instead of the money on my bank account. I mean, what Tether does is it holds money in bank accounts, right, as a backup. So you're still exposed to the credit risk of the banks. So what would actually be a true stable coin would be to say, let's hold, and now coming back to my very first comment today, instead of holding commercial bank money as a backup, let's hold central bank money as a backup, because then we're not talking about fractional reserve banking, but we're holding this true money in vaults, right, as a backup for our stable coin.
Good point. Yeah, you got me there. That's why I only hold DAI and not USDT, but fair point.
I mean, I think we should go into that point because, you know, we had Tether, which came about relatively early on. Like, correct me if I'm wrong, but I think Tether was even running on the Bitcoin blockchain for quite some time. And Tether is still like the giant in the space. Like, I think it's like 80% of all stable coins. But in the last year, we've become increasingly excited about DAI. You know, MakerDAO is effectively a decentralized central bank. So we had Bitcoin, which was monetarily different and technologically different. And then we had Tether, which was monetarily the same, and then technologically, the technology of blockchain, but monetarily the same. And then we had the MakerDAO, which allowed us to get rid of these centralized shackles. Now, there's pros and cons to that, but can we not agree that in the future we are looking at a system where we can have a stable coin without any kind of centralized entity worrying about bank balances?
Yeah, I think so. Maybe also responding to you, Emmanuel, holding everything in DAI is of course an approach, but also we definitely need to mention that that also DAI is still like in a very early stage. And we also see kind of a huge centralization also in that space, if you want so. And in the end, yeah, so there could be bugs somewhere, and so we've seen it a couple of dozen times, and also in the blockchain space. So therefore, probably it's good to put some money into DAI, but also hold some money somewhere else as well.
I think the fact that we're having this discussion is showing something really important, that now we kind of have this competition of money, right?
Exactly, and it's about like the whole space is maturing, and it's good to see this whole space maturing. But in the end, yeah. So I just wanted even being super enthusiastic about everything we talk here. We definitely need to also keep an eye on that. We're talking about early technology.
Agree. Does someone have like, because maybe for the listeners, it's not so clear how what you can do with stablecoins and like really how innovative they are. And again, without talking about decentralized finance, but like maybe remittances or something. Does someone have a good example of a use case with remittances, or even just if they don't have an example, maybe just explain the whole user experience of sending a stablecoin to the other end of the world or something.
I think so. I would probably jump in here, but maybe the others also have other examples. I like the one that Professor Philipp Sandner is giving like everywhere all the time, because he's always talking about the machines that are producing tokens. For example, I don't know, like a sun collector or some machine which is producing some output. You tokenize that output, and then you can create that financial supply chain that automatically generated asset back in form of a stable coin. So you would have like a completely automated transaction cycle over there, and probably the machine would buy its parts and ingredients and power supply or whatever from with this tokens as well. So you would have kind of completely autonomous machines that do stuff and kind of generate something, and you would automate the whole financial supply chain around it.
So maybe to summarize the point, Peter, because we lost you for a couple of seconds, but I believe I know what you were talking about. The idea is basically that we have business processes in the future that run over blockchain, right? So certain things run over blockchain in the future from the business perspective. And the problem today is that we somehow have to connect these processes to a means of payment. And if a business process runs on a blockchain, it would be really good to have a means of payment that sits on the blockchain, because then the two are interoperable. And today you have Bitcoin on the blockchain, so you could settle these payments with Bitcoin. But of course, in particular, if you think about the industry does not want to settle these payments in Bitcoin. They want something that's either directly the euro, this would be perfect, or at least something that comes really close to the euro. And a euro stablecoin would be something that comes super close to the euro. So this would be a reason why you would want to have the euro on the blockchain, so to say.
Yeah, and just to add one last point, and to make it really simple, because you mentioned remittances, Emmanuel. So, I mean, imagine just some kind of, I don't know, for example, Filipino worker in Germany who wants to send money back to the Philippines. He's nowadays, he has to like face at least I don't know, 7 to 10% of transaction costs for sending back fiat money. It lasts at least a couple of days, if not like a week or more, in order to make his payment work, and in order to finalize it. And if he just sends through his like crypto wallet a stable coin on the other side of the planet. I mean, of course, there's risk involved, as we mentioned, but the whole thing probably it takes him 2 minutes of time, and it costs him, I don't know, a couple of cents of transaction costs. And that's the really simple and obvious selling point of stablecoins in remittances. And that's how you, I mean, that's basically one of the main use cases that I think the Libra Association wants to address with his stablecoin.
Yeah, I agree. And I think, as Alex mentioned before, there's still a bit of a trust problem where big companies or payment companies don't really work with these stable coins. So it is adopted. There's a lot of people using it, but it's really more peer-to-peer way, where someone in Germany, for example, goes on an exchange, you know, sends his euro there, buys some USDT, sends it over to the wallet of, you know, a relative in the Philippines, and then that person needs to go again through an exchange and out from it. So it's a bit of a manual process, and it works more in a peer-to-peer way, but it's not really adopted by any big companies that make the whole transfer kind of end-to-end and seamless. So I think the trust, there's still like a bit of a barrier in terms of adoption of stable coins.
So you do see more adoption in places where the people can't trust their governments to have stable monetary policy. So for example, Argentina, Venezuela, and people were always buying Bitcoin, and the price of Bitcoin were higher in these countries because of the relative demand. And now people are going into DAI. So it's kind of, you have the benefits of having a stable asset, then you also have the benefits of blockchain, which I guess for these people in particular is self-sovereign money. It's permissionless. So you can hold your own cash and you can deal with it without any kind of controls or permissions or regulatory bodies.
Yeah, let's maybe switch to decentralized finance now, because in a way also these stable coins gave birth to decentralized finance, because suddenly you had like this stable asset, this dollar equivalent or this euro equivalent on a blockchain, and paired with the programmability of Ethereum smart contracts, you could build applications that would use financial applications that would use these stable coins and make something productive with it. So this is a huge trend at the moment. Patrick, I know that Bitkom wrote a big white paper or research paper on this. So maybe you want to explain what decentralized finance is for you?
Yeah, sure. I mean, in its simplest like form, decentralized finance are like applications that run on top of blockchain systems and that automate financial services. And in the end, those decentralized finance applications are nothing else than a couple of smart contracts bundled together, and they automate and execute automatically some kind of financial transactions and financial services. That could be like lending and borrowing services, that could be derivatives, that could be prediction markets. And I mean, without going too much into detail, like how these decentralized applications work is that users provide liquidity, and those smart contracts like build up liquidity pools where users locked in some kind of assets, for example, Ether or others, and then other users who want to like make use of those applications and, for example, exchange some kind of asset, they exchange their assets not with a central intermediary, like in the traditional finance system with a bank or so, but they interact with the liquidity pool. And in the end, there's a small transaction fee going to the providing users that provide the liquidity. And just one last point is maybe to also give a quick explanation on why this whole DeFi sector just rose so like dramatically in the last couple of months. And I think the main explanation is up until now, you know, DeFi users and DeFi liquidity providers, they gained some kind of transaction fee. And so by providing liquidity, they benefited from it and they got some transaction fees back. And now, a couple of months ago, there was the first introduction of so-called governance token from some kind of decentralized applications. The first one, I think one of the first one was, or the most known one is Compound, the comp token. And those decentralized applications and wanted to incentivize liquidity providers and users of their protocols, and did that by just distributing governance tokens to all the users of those applications. And I mean, as always in the crypto sector, there was a whole speculations built around it, and those governance tokens had their prices rising like very quickly, and that provided that led to the really bizarre situation where users got basically not only the transaction fees back for their liquidity providing services, but also the governance token of those decentralized applications. And that also is the main reason for those just huge yields that were created in the decentralized finance space of up to like 100% APR or annual like percentage returns for their locked-in assets.
Yeah. Yeah. Someone wanted to say something.
Yeah, I would say to quote Bill Gates, you know, before he manufactured the whole Corona crisis or whatever, we need banking, but we don't need banks. And cryptocurrency allowed us to have this functioning currency without banks. But it was just the most basic form of transfer of value. So just Alice sends Bob, you know, whatever. But when we have DeFi, which is for smart contracts, we can have more complex financial services and products. And this is effectively creating a parallel financial system to what we know as traditional finance today.
Yeah, I think that's a good point, because these governance tokens definitely brought everything to a new level. But let's focus a bit on how these applications are different, because it's such a huge contrast to how banks work. So let's focus a bit on these differences. Peter, do you want to explain a bit how a protocol works, how how basically it is based on smart contracts, how it can be accessed through various interfaces, all these differences to a normal bank account?
Well, so probably we need to start with smart contracts and explain a little bit more than we had before, because in the end, so also like Alex mentioned in one of his comments earlier, what we found with the Ethereum blockchain is the programmability also of blockchain, so that you're able to deploy smart contracts that are small programs that run on the blockchain and run it kind of on this decentralized network of nodes and execute them and provide functionality. And so the DeFi space for me personally is kind of a bit, and as we are in the payment and banking webinar, and you're talking here also a lot about fintech and companies like fintech companies. Personally see the developer a bit as like the next stage of fintech, or I don't know, fintech 2.0 or however you want to call it, because in the end, so I think the use cases that you find with fintech and financial companies still are the same, like in the traditional world, but you are able to provide it in a different way. So for example, if you invest some money through a fintech company, you usually, or there's the two options: the fintech company has some sort of license, or it's collaborating with a bank behind it, and then most likely you're consuming a service which has been provided by a bank, where the front end was outsourced to the fintech company, and that's kind of like the traditional world. How it works. And in the today's decentralized DeFi world and in the world of smart contracts, you can do it in a different way, so that in the end the protocol can be implemented in a way that users can interact with each other, and kind of their, like, the use cases that you find in the traditional financial world, so like investing, lending, and sending money from A to B, and so on and so forth. I think these are the main use cases that we would always have in the financial world, and these are now provided in a different technical way.
Yeah, I think some of the important characteristics are also that it's basically completely permissionless. So like anyone in the world can use, for example, a lending protocol like Compound, which Patrick mentioned. So anyone can suddenly has the ability to put USDC into a smart contract and earn interest on it without having to ask anyone for permission. So suddenly someone in a remote part of the world has sort of a US bank account with that pays even a higher interest than a normal US bank account. So this, I think, is really cool, this permissionless aspect. But yeah, Ben, you look like you have something to say there. And also, I actually wanted to give this question to you anyway, because I know that, and you mentioned in my podcast that at Bitwala you're thinking about integrating such a smart contract into the wallet or something. And so, like, what is the difference, for example, in doing that from partnering, for example, with a normal payment provider in the space? Like this aspect of basically not having to ask anyone, just going for it.
I think it'd be helpful if we take a step back and look at fintech versus DeFi, because there has like a massive fintech bubble, and we have the unicorns like N26 and Revolut and TransferWise, etc. And the way we classify it at Bitwala is fintech has succeeded in disrupting the distribution of financial services, whereas decentralized finance allows us, for the first time ever, if we're honest, to disrupt the actual infrastructure of the financial services themselves. So if you look at N26, it's a wonderful brand and user experience, but it's still on top of old-fashioned traditional banking, right? If we look at TransferWise, it basically only exists because Swift doesn't work properly. And so we need to have this hacky layer on top to make international payments happen. So these fintechs have managed to carve out a tremendous value just by making the distribution of these financial services more attractive for the average person. And then with decentralized finance, we can actually create new infrastructure. And right now we're in a very, very early stage, but I think that is kind of the most important thing about decentralized finance for me. It is the rate of innovation we will see in DeFi is far faster than that of traditional finance and fintech. So the code is open source. The protocols are permissionless. They're standardized and they're composable. So you can just hack together something by plugging in a decentralized exchange together to some lending provider, and then you have this new products and service. We will see the level of innovation continue to rocket ship up, and that will create more and more use cases for the average person. I don't want to spend too much time plugging Bitwala, but we basically say that all of the innovation that is being created, well, it's still way too inaccessible for the user. There's trust issues, there's usability issues. Users think in terms of euros and dollars and not in terms of DAI and gas. And so what we think is you need to have a centralized counterparty which acts as a wrapper, which can then broker the user's funds into various DeFi as an intermittent step. I believe fundamentally that we will be living in a decentralized utopia in the future, but to cross the chasm and to get the early majority into DeFi, there needs to be this additional centralized trust layer, because that's frankly how people are used to dealing with financial services.
But I think here it's really important that you say it's an intermediary step, because it, of course, conceptually make no sense to use anything that's centralized within a DeFi universe, because the whole idea of DeFi is, of course, as you said, Ben, that it's completely decentralized. And on that point, I wanted to make one more comment, because we were talking before about stablecoins like Libra or USDT. that are actually centralized, right? There are banks standing behind this, so it makes no sense whatsoever to use these kind of stable coins in a DeFi environment. So we are really talking about these completely decentralized stable coins that would be used in these environments. And as a last point, we are super early in this space, right? I mean, these decentralized stable coins are super early, and the DeFi applications are even earlier. So just as a note of caution, I mean, this is experimental ground currently.
Yeah, I would agree to that. Yeah, I think we're kind of coming to an end here, not in terms of topics, definitely not. We will actually a lot more to discuss, and didn't even discuss central bank digital currencies, but in terms of time, as we promised that this would take not more than an hour. But I mean, I think it shows how interesting this whole thing is. Definitely worth doing a second episode more on central bank digital currencies. Does someone want to or everyone, anyone who wants to say something to finish, a couple of finishing thoughts? Let's finish by that.
I would just say try it out. Like, just Google how to get started with DeFi and just mess around. You'll spend way too much on gas fees. That's another topic, but that is the fastest way of learning, to actually get your hands messy.
Yeah, I would say one last thing about Ethereum, since we used a lot of time talking about Bitcoin. And as Ben mentioned, there's a completely new financial infrastructure being built right now on top of Ethereum. And that's why I think maybe next time we should also reserve some time talking about Ethereum and all those functions and use cases it offers. Since, I mean, on top of, being possibly such as Bitcoin a store of value asset, Ethereum just offers this, in the end, commodity function, since you use Ether as your entry means towards this huge, new decentralized financial infrastructure. And in future, maybe when Ethereum uses proof of work, you could also use Ether as a capital asset and stake it and earn interest in it. So I would say, compared to Bitcoin, it just offers so many different and additional functions that it would definitely make sense to have a discussion about Ethereum maybe next time.
Yeah, I would also have covered the thing of staking, because so I think the best thing is, like Ben said, to try it out. I think that's also how we all got into the space. We tried it out, and probably in earlier days with less tools and less descriptions to figure out how to use Bitcoin and other stuff. But I think it's a great moment to get into DeFi, and also to wrap your head around staking, and also use this as like a passive investment vehicle. And so it's I think definitely worth having a look.
Yeah, so I'm extremely disappointed that we didn't cover CBDCs, because that's my most favorite topic. No, jokes aside, I think the last point I would try to make is, we talked about different forms of money today, right? Bitcoin, stable coins. We didn't cover CBDC, but this would also be one form of digital money. And I think it won't be one winner takes it all in the future, right? We will have different use cases for different forms of money, and they will coexist in the future. So we'll even have more different forms of money coexisting than we have today. One that is maybe used in the DeFi space, one that is used for remittances, else that is used for wholesale payments made by the industry. So there will be a coexistence of different forms of digital money in the future. That's my opinion.
Yeah. I would just finish by saying that these, as Patrick mentioned, a lot of these DeFi protocols have introduced governance tokens. So basically, these protocols fulfill the same services that also centralized companies fulfill, like lending or trading. but they are decentralized, and they are basically, they distribute ownership to a large number of people. So there's not like one person or a few shareholders who own that company, but really the users who use the protocol, who also own it. And with those governance tokens, they basically are allowed to vote on improvements to that protocol, on new new functions, new features. And in the same time, this governance token also has a value because they are entitled to a portion of the fees that the protocol generates. So it's really a new form of equity, so to say, equity for digitally native companies. And I think this is incredibly interesting. And I, like Ben, I can also only say, try it out. I'm willing to, like, anyone who's interested. I have no idea how many people watch this, maybe just 5 people, but in case there's anyone who's actually interested, like, message me. And also my website cryptotesters.com tries to answer some of the common questions that people have when they start the journey. And with that being said, thank you very much for listening, and thanks to the awesome panel.
Thank you. Have a good one, everyone.
Thank you.
Thank you.
Bye,
Bye-bye.
everyone.